everyone. Thanks for joining us today. Today we're going to get into, I guess it's an old Wall Street adage of sell in May and go away. So suggesting that people, I guess investors, to sell out of the market for the anticipated summer slump months. But you and I looked at some historical numbers and found that that's not actually the case. So why don't we go through some of those stats?
Yeah, so I mean, first we should just say we don't employ seasonal trading. It's interesting to look at, but it's not something we have a lot of faith in. And the sell in May, go away adage, as you say, is often talked about, but not as much in recent years because I think people are starting to look at the data and see that there's very convincing evidence that it makes no sense at all to liquidate your stocks in May and then buy them back at the end of October.
Right. In fact, we found like for instance in 2008 during the financial crisis, the summer months, the 6 months spanning, actually had um, I guess 68% of the time had positive returns.
Yeah, just to clarify that, it was since 1930. It was positive
Right.
68% of the time. But then when you look at data since 2008, it's now positive 72% of the time. And the average return from the beginning of May until the end of October is 3.6%. So why would you sell, right?
Yeah.
Why don't we just talk about the reason this trade gained some traction? In the 1980s, interest rates were significantly higher than they are now. For example, in 1981, the 10-year Treasury was over 16% per year. That's the return you would get by owning a risk-free asset. And so the sell in May, go away trade was to suggest that if you look at stock market returns between May 1st and the end of October versus November 1st to the end of April, they're generally higher from November the 1st till April 30th. And so if you are to take some money off the table in these summer months and put them in high yielding fixed income securities, it would get you a better return than earning that 3.6% that we talked about. But now interest rates are a lot lower. And so it doesn't make sense to do that anymore. Today, the 10-year Treasury is about 4.3%.
Right.
And that's for the whole year. So the trade has lost its traction. That is for sure.
Yeah, and not to mention that when people do sell off, they're dealing with transactional fees, capital gain,
Mm-hmm.
capital gains and losses, and that's costly.
Yep, absolutely. And also,
Hmm.
it's hard to buy stocks at a higher price than when you sold them. Just from a pure emotional perspective, if you sell a stock at 50 in the first week of May, and then in November it's 60, it's hard to buy it back. Okay, just take
Yeah.
my word for it. So you're dealing with that too. So
Hmm.
we don't do this at all for clients. We're fully invested right now, and as dividends come in and build a cash balance in each account, we use those cash dividends to buy more stock.
Yeah. So it makes more sense to just buy in, I guess, long-term hold positions
Yeah.
uh, versus selling off.
Yeah, absolutely. I was talking to a client just the other day on how amazing it is that if you had have told me in the last 13 months there would be the tariffs, war in Iran, all sorts of attack on Jay Powell from the Federal Reserve, Canada's slowing economy with USMCA uncertainty, all these things, and all of our portfolios are pretty much at record highs.
Yeah,
So never time the market. You always want to be
that's
fully
right.
invested.
Yeah. Okay. I think we've covered everything.
Yeah. All right, Sonny,
Great.
thanks very much.
Thanks, Jeff.